welcome. You're watching Managing Money with Moneycontrol. I'm Sakshi Batra. Well, the retail investment space has seen a bit of a churn in the last few weeks on the back of Budget 2020. Investors now have a choice of whether or not to avail the tax deduction benefits on small savings schemes. And this is where we will discuss if you will really need to tinker with your debt portfolios in the view of the recent changes and the options before you now. Joining me to simplify the tax math for you is Mr. Amit Singhania, partner Shardul Amarchand Mangaldas. Thanks a lot, Amit, and good to have you back on Moneycontrol.
Thanks for calling me back again. Thank you.
I want to understand from you, first of all, the small saving schemes where most of the investors used to invest to save taxes. Do they actually lose sheen because of the withdrawal of the tax benefits or not? Because they actually used to give twin benefits or advantages to its investors. One was the government guarantees and also higher returns.
That's a very interesting question, and these days everyone is grappling with, after this particular deductions on the small saving schemes has gone, whether these small saving schemes still be into the limelight or the people will opt for it. To my mind, we haven't seen a particular environment in which these scheme has assailed without having a tax benefit.
Okay.
Since the era of the independence, these small savings scheme has been under the usher of the tax incentive. So we have always seen these schemes coupled with the tax benefit. This for the first time which is happening, that these schemes, rather you will have the flexibility to avail these schemes without having a tax benefit, and you will be required to pay taxes upon the return earned on these schemes. So this is for the first time that people are encountering this, and we are trying to de-link the tax saving and these these small saving scheme. It needs to be seen that how the people are going to invest into these schemes without having the tax benefit.
Sure.
But I'm sure, look, tax saving is an important tool, and these schemes and these tax benefit are an important tool for attracting the investment into these small saving schemes. But apart from that, we need to have the another angle, whether you actually require to have a savings or not. And it all depends upon the person to person. For example, the millennium clause that you can take, they want more cash in hand. They don't believe into these schemes, and they want to spend all of the money. If you go higher up the age, people will go for a scheme irrespective whether there's a tax benefit associated with the scheme, because they believe into the saving.
Right.
So it all depends upon the perception. It all depends upon the person's circumstances of the, yes, but this is going to be the interesting thing to watch, that how much these schemes are going to attract the investment without getting any kind of a tax benefit.
Right. And in fact, let's break it down for all our investors who have been investing in several schemes. Let's begin by asking about not the millennials, but the higher ups who actually invest in, say, senior citizen savings scheme, or maybe for their children, they invest in Sukanya Samriddhi Yojana as well, because these give high returns and also tax benefits as well. So should people who have been currently investing in these schemes continue to invest without the tax benefit also if they opt for the new tax regime?
Look, for example, if you take these three schemes, one is the senior citizen savings scheme. I think it's offer around 8.6% per annum. And if you take the Sukanya Samriddhi Yojana scheme, it offers around 8.4% per annum, and the PPF approximately 7.9 to 8%, and the interest rate in these schemes actually vary on a year-to-year basis. But to my mind, having a sovereign guarantee on these schemes coupled with such a reasonable rate of interest still makes them the attractive proposition to invest. And to my mind, people will still go for these particular scheme, because if you also adjust to the inflation part of it, 4 to 5% of the inflation, still your money is not depreciating along with the sovereign guarantee. Plus, you are also getting to save.
Absolutely. Now, I also want to understand, Amit, about, say, National Savings Certificate. Now, will people continue to invest in that, or maybe they will choose, say, government bonds which offer higher interests?
Yeah, that is going to be interesting, but there are 2 points. First of all, the NSC, I think, offer around 7.9% of the interest.
Correct.
The government bond may be fetching a little bit near about the same, but the tenor of the NSC is around 5 years, and the tenor of the government bond could be higher than the 5 years. So if you want to block your money for a higher term, then you can go for a government bond. But the another distinct advantage of the government bond is that whenever there is a redemption which happens, it is liable to be paid as a capital gains tax.
Okay.
So that means, for example, a government bond of 7 years, you will be paying a long-term capital gains of 20%, vis-a-vis the NSC, without any tax break, without any tax incentive, it will be offered to tax at the rate of 30%. So 10% arbitrage is still there between the government bonds and the NSC.
All right. Let's actually go forward and ask about, say, Bharat bond ETFs. How should investors view Bharat bond ETFs vis-a-vis the traditional methods of saving, that is, say, fixed deposits, and considering the fact that in under the new tax regime, over 5 years of the tax benefit that you get on FDs will also now not be there?
Yes, so the ATC benefit associated with the traditional FDs will not be there in case you are opting for a new regime. For the Bharat bond, actually the rate of interest vary from different types of the categories of the Bharat bond. It could range from 6.69% to 7%. Vis-a-vis the fixed deposit, if you see, the approximate range is between 5 to 7% of the fixed deposit. And if you have to pay tax upon this, then the effective post-tax yield will be around 4 to 5%.
Okay.
But in case of a Bharat bond, because as I said that they are governed by the capital gains regime, so the 10% arbitrage will be there. So the Bharat bond may be more tax efficient, and considering the yield in both the cases is approximately similar.
All right, so that will be better efficient. Bharat bond ETF is still attractive for all the investors looking out for savings vis-a-vis the fixed deposit option as well. But apart from this, I want to say that small savings schemes have been the go-to options for the people whenever they wanted to enhance their debt portfolios. So now, under the new tax regime, do you think most of the investors will be looking out for different debt allocation prospects, and even could they also go for debt mutual funds then?
Yes, people can go for a debt mutual fund, but one needs to consider it in case you are investing into the bonds and that to the government bond. The government won't invest into the debt portfolio of the PSUs.
Correct.
Vis-a-vis the debt mutual fund, they can invest into the private companies also.
Correct.
So from that particular perspective, the risk element into the debt mutual fund could be higher in terms of ranking vis-a-vis the government bond, which actually only invest into the debt of the PSUs.
Okay.
But apart from that, the debt mutual fund is also exposed to the market risk to a limited extent.
Exactly. And
To a
apart
limited
from that,
extent, yes.
what about the tax angle on that? Because you have the capital gains tax
so
also, the
yes.
mutual funds will also deduct a 10% TDS withholding as
yes.
well. So how do you view that then?
So in case of the government bond, as I said, that it will be governed by the capital gains regime. But for the debt mutual fund, they will be declaring a dividend from whatever earning that they may be having, and the dividend will be taxed at the appropriate marginal rate of the individual. Although the mutual fund industry will be deducting 10% tax, but that will be creditable against your slab rate.
Okay.
So the tax rate could be as high as 30% as well. Vis-a-vis the government bonds, where the tax rate is capped at the 20% in case you are investing more than 3 years.
All right. Thanks a lot then, Amit, for sharing all these insights with us. And I hope these have really helped all our viewers make the decisions on how to go about their investments in small savings schemes. With that, it's a wrap here. Many thanks for tuning in.